a single mother in Ohio just overdrafted her account buying groceries. At the same moment, a tech investor in Silicon Valley watched his portfolio gain more in 1 hour than she'll earn all year. Both are part of the American economy. But they're not living in the same America. In 2025, the United States is producing record corporate profits, historic stock market valuations, and revolutionary advances in artificial intelligence. At the same time, millions of Americans can't cover a $400 emergency. Credit card debt has hit all-time highs. Rent consumes more than half of income for working families across the country. The headlines say the economy is strong. And they're right. But so are the families drowning in debt. How can both be true? How can one America surge forward while another slowly suffocates? This is the story of two economies living inside the same country. One built on capital, assets, and automation. Another built on wages, debt, and survival. And it asks a question few are willing to confront: is this divide temporary, or is it permanent? On paper, America looks unstoppable. According to data released in late 2024 by the Bureau of Economic Analysis, U.S. GDP continues to expand at a pace stronger than most advanced economies. Corporate earnings remain elevated. Productivity in certain sectors has surged, and the S&P 500 has climbed to heights that would have seemed impossible just years ago. But look closer at what's driving that growth. It's not small businesses or consumer spending. It's a narrow group of dominant firms, technology giants, financial institutions, and AI-driven corporations. Reports from McKinsey and Goldman Sachs in 2024 show that companies with high capital intensity, those that rely more on technology than labor, are capturing a disproportionate share of economic gains. Artificial intelligence is accelerating this split. According to analysis from MIT and Stanford published in 2024, AI adoption boosts output and profitability fastest in firms that already possess capital, data, and scale. These gains rarely translate into proportional wage growth. In other words, the economy is growing, but not evenly. This is the first America. The asset economy. The investor economy. The ownership economy. If you own stocks, property, or scalable businesses, the system is working. If you don't, it isn't. Now let's shift perspectives. Away from markets. Away from earnings calls. Away from GDP. And into households. According to the Federal Reserve's 2024 data, real wages for lower and middle-income workers have barely kept pace with inflation, even as prices for housing, healthcare, insurance, and education continue to rise faster than overall inflation. The Bureau of Labor Statistics reports that while unemployment remains low, job quality has deteriorated. More Americans are working multiple jobs. Temporary, contract, and gig work have expanded faster than stable full-time employment. At the same time, household debt has exploded. Data from the New York Federal Reserve shows that by 2025, total household debt has surpassed previous peaks, driven primarily by credit cards, auto loans, and rent-related borrowing. Families aren't spending frivolously. They're borrowing to survive. This is the second America. The paycheck economy. The rent economy. The survival economy. It doesn't grow. It stretches. And eventually, it snaps. This divide didn't appear overnight. Economists at the Economic Policy Institute and the Brookings Institution trace the roots of America's dual economy back decades, but they note that the acceleration since 2020 is unprecedented. Three forces converge to tear the economy in two. First, asset inflation outpaced wage inflation. Low interest rates during the pandemic years inflated stocks and housing. When rates rose, asset owners were protected by equity and appreciation. Wage earners were hit by higher borrowing costs with nothing to cushion the blow. Second, productivity gains stopped flowing to workers. According to a 2024 analysis by the OECD, U.S. labor productivity has grown far faster than median wages over the past 20 years, a gap wider than in most developed nations. Workers are producing more value than ever before. They're just not being paid for it. Third, essential costs detached from income. Housing data from Harvard's Joint Center for Housing Studies shows that rent growth in major metros has far exceeded income growth since 2021. Healthcare spending continues to rise faster than wages, according to the Centers for Medicare and Medicaid Services. The things you need to live keep getting more expensive while your paycheck stays the same. The result is a system where economic growth exists but is inaccessible. In one America, people talk about investments, AI tools, and financial optimization. In the other, people talk about bills. A 2024 Pew Research Center survey found that nearly half of Americans feel they are falling behind, even when employed full-time. Bankrate surveys show that savings rates among lower-income households have collapsed, while higher-income households increased investments during the same period. This creates two emotional realities. One defined by opportunity. One defined by anxiety. And the longer this gap persists, the harder it becomes to cross. The invisible wall between these two Americas grows taller every day. Artificial intelligence did not create the divide, but it is reinforcing it. Research from the International Monetary Fund in 2024 warns that AI disproportionately benefits high-skilled, capital-owning sectors while displacing or stagnating wages in routine and middle-skill jobs. Here's how it works: AI boosts profits faster than pay. Companies automate tasks. Costs fall. Output rises. But wages don't follow. The gains flow to shareholders, not workers. The asset economy compounds. The labor economy competes for scraps. This isn't a future problem. It's already happening. The AI revolution is making some people wealthier than kings while leaving others further behind than ever before. From a policy perspective, the economy looks functional. GDP grows. Inflation stabilizes. Markets remain confident. The system calls this success. But GDP does not measure stress. It does not measure insecurity. It does not measure fragility. It does not measure fear. Economists increasingly warn, including in 2025 papers from the Federal Reserve Bank of St. Louis, that macroeconomic indicators no longer capture lived economic reality. You can have a booming economy on paper and a collapsing society in practice. In short, the economy can grow while people suffer. History shows that sustained economic bifurcation is unstable. Political economists from Princeton and Yale note that when large segments of the population feel excluded from growth, trust collapses. Voter anger rises. Institutions lose legitimacy. Social cohesion fractures. This is not theoretical. Surveys from Gallup and Pew in 2024 show declining confidence in economic leadership, even during periods of reported growth. People are losing faith in the system because the system is leaving them behind. When people feel trapped, they don't care about charts. They care about survival. And when enough people feel that way, democracies don't stay stable for long. There is no simple fix. But research suggests several pressure points that could begin to close the gap. According to the Congressional Budget Office and Brookings analyses, wage growth must reconnect with productivity. Workers need to share in the value they create. Housing supply must expand beyond investor demand. Healthcare and insurance costs must stabilize. Most importantly, growth must become broad-based again. It can't just flow to those who already have wealth. Without that fundamental shift, the two economies drift further apart. One accelerates. One suffocates. America does not lack growth. It lacks distribution. It lacks access. It lacks balance. The most dangerous myth today is that a strong economy automatically means a healthy society. It doesn't. A country can grow richer while its people grow poorer. And unless the divide between these two Americas is confronted, honestly, structurally, and urgently, the question won't be whether growth continues. It will be who it leaves behind. The future of America isn't about choosing between growth or fairness. It's about deciding who growth is for. Right now, we've made our choice. The only question left is whether we're willing to live with the consequences.